QuickBooks Online 2025. Record short-term investment in stocks and bonds. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation. We're going to open the major financial statement reports as we do every time. The reports are located on the left-hand side. We're in the Standards tab. In the Favorites area, right-clicking on the balance sheet to open a link in a new tab, right-clicking on the profit and loss to open a link in a new tab. Let's tab to the middle where the balance sheet is located, close the hamburger, do a range change for 1 year, 01/01/25, 12/31/25 tab, and then we'll run it to refresh it. Tabbing to the right, closing the hamburger, repeating the range frame, 01/01/25 tab, 12/31/25 tab, run it to refresh it, noting nothing's currently in 2025 profit and loss. But if I go to the balance sheet, we do have items in here because we have those beginning balances that we are imagining we pulled in from the prior accounting system. And now we're continuing on with those transactions that are typical for a new business that needs the capital to generate money, in other words, so they can then take that money and invest it in the things that are going to help them generate revenue, often being the property, plant, and equipment, the fixed assets, the depreciable assets. So last time we got money in the bank by, one, transferring money from our personal account into the business account, and two, by taking out a loan. Now that we have a significant amount of money in the business, we're going to take a little bit of that money and put it into short-term investments, which could be and oftentimes is stocks and bonds, possibly mutual funds, for example. Now, as we do this, we want to point out the rationale in terms of why we would do this and think about what the transaction would be here. And then also, as we do this, I want to think about what the transaction might be if we were doing it for our personal accounting as well. Because if you're a bookkeeper, note, you could do bookkeeping for your own books as well, using either a separate QuickBooks file or possibly, if you have a small business, you might have a Schedule C type business, Schedule C being reported on the tax return, in which case you might be able to get away with one QuickBooks file having the balance sheet for both your business and your personal bookkeeping, and then on the income statement breaking out using class tracking by column, the business versus the personal. So again, we have a whole nother course or section on those ideas if you want to get into that in more detail. But if I go back to the balance sheet here, the general idea then would be, what is the difference if you're investing in stocks and bonds for the record keeping on the personal side versus the business side? The one big difference, or one of the big differences that makes the accounting a little bit different, is that the objective is not as clear on the personal side as the business side, which is why it's great to separate the two things. In other words, on the business side of things, it's clear what we're trying to do from a business standpoint, and that is generate revenue. Everything we do can be measured from the generation of revenue, noting that some people will argue that revenue generation isn't actually why they have the business, because they'll say that they want to do whatever they want to do. I want to make, again, the perfect poodle hair cutting profession, because if the poodle's hairs are cut nicely and everybody's really happy about the poodle's haircuts, then they're happier, and then the world becomes a utopia, and they become a utopia because of our great poodle hair cutting. That's great. But one way that you can measure how good you're doing is, of course, through the revenue. If you're actually making money doing what you're doing, that's one measure that it's actually being successful, right? So in any case, on the business side, revenue generation. On the personal side, not so much. It's kind of like a not-for-profit organization. With a not-for-profit organization, we don't have the same concept of revenue generation, and therefore it often leads to bloat. That's why government entities, as well as not-for-profit entities, including like churches and whatnot, often have a lot of bloat in terms of what they're paying possibly to executives and whatnot, because they don't have the market pressure to really trim the fat on that kind of stuff. Similarly, on the personal side, when we do our personal bookkeeping, we don't really have a clear objective or goal other than to live well. So that means that on our personal side, we will also end up having bloat. We won't be able to trim the fat as easily because we're just going to spend more and more. And if we have the capacity to do so, we get out of control until we tighten the belt for whatever reason. Either we hit the wall or we decide just it would be healthy for us to tighten the belt budget-wise, in which case we're going to trim things down, right? So if we're on the personal side, these investments are one of the things that we often have to deal with. I'm going to close this up to the accounting equation again. On the business side of things, why would we have money in an investment? I just want to remember the accounting equation, assets equal liabilities plus equity, can be thought of as the assets what the business has to generate revenue, including cash. We don't have the business just to hold on to cash. If the cash isn't going to be used in the business, in other words, we should give it to the owner in the form of a draw or, if corporation, a dividend. Liabilities represent the third-party claim to the assets, like the bank for a loan. Equity represents the owner's claim, whether it be a sole proprietorship, one person, partnership, multiple people, or a corporation ownership evenly distributed share by share, and having the distribution of those shares represent different ownership allocations. So that means that if I have a lot of cash in the business, then I might want to put money on a temporary basis in stocks and bonds, such as a short-term investment. Why? So I can make some money on the stocks and bonds as I'm holding on to the cash. But typically, if I have a whole lot of cash and I'm holding on to it for a long point of time and I don't need it, that's when you would think that you would give it back to the owner in the form of a dividend. So if I had a business and I had a personal account, then typically if I generate money through the business, I want to invest it, usually I would take it out of the business with a draw or dividend, and then on the personal side, put it into stocks and bonds, basically on the personal side of things, which we could be tracking as well in our QuickBooks file. Now, there's one kind of exception to this rule, because you might be in a business that is an investment business. The business itself is investing in stocks and bonds, right? If that were the case, then of course you will have investments in stocks and bonds as your primary kind of business model. But most other businesses aren't financial businesses. They're not in the business to invest in stocks and bonds. In our case, it might be a restaurant, it might be a movie theater, it might be a store. In our case, we sell guitars. Therefore, we're not going to have our primary income come from investments. They would only be in investments for short-term type of investments. All right, that said, then what do we want to do here? We want to take some of this money that we haven't yet spent, and we're going to hold on to it for a little bit of time before we spend it on the property, plant, and equipment, put it into short-term investments like stocks and bonds. What's the journal entry going to look like? It's going to be decreasing the checking account, and it's going to go into a short-term asset, which we're going to just call investments possibly. Now, next thing to note on investments, and this is often more on the personal bookkeeping side, which again, you can also do in QuickBooks, but it also could come up on the business side. And that is, how much detail do I want in QuickBooks related to the investments? So most of the time, individually, we're investing in, say, under the umbrella of a retirement plan, like a 401k plan, 403b plan in the United States at least, or a IRA, for example. So in that case, usually the driving instrument that we're investing in is not one stock or bond, but rather a mutual fund or ETF of stocks and bonds under the umbrella of a retirement plan, like a 401k plan. The 401k plan restricting us from having access to that money. Only reason that we set up it under a 401k plan or retirement plan is because we get a tax benefit. So that would be the general idea. You could have some money in investments that are outside the 401k plan. Whether it be under the 401k plan or outside the 401k plan, it's going to usually not be in individual stocks, but rather oftentimes in mutual funds. That's what mostly small business investors do. Mutual funds having multiple stocks and bonds pooled together so that we can have a diversified portfolio by pooling our money with other investors, as opposed to trying to diversify putting money in multiple stocks and bonds ourselves. So that means that when I might have my money in multiple institutions that then put money into the mutual fund. So I might be investing through E-Trade or through my bank, like Bank of America, or through Vanguard, for example. These are some of the big ones that you might be investing through. So oftentimes I would recommend in your bookkeeping software like QuickBooks, we're just going to possibly make an account per investment vehicle or the company we invest with, like Vanguard, E-Trade, and our bank, and so on and so forth. And within there, where most likely most investors are going to have large mutual funds, possibly multiple mutual funds, like a short cap or small cap, high cap, or whatever, in the mutual funds, although there could be individual stocks as well. And again, I would still group that under who we invested with or through the broker company, such as Vanguard, for example, or your bank, for example, or E-Trade, and not have all the detail. And you might, when you want the detail, where would I get the detail? Well, I could go to the actual website itself that we invest with, like E-Trade or Wells Fargo or whatever, and look at the actual activity in detail there. That's not what QuickBooks is for. QuickBooks is not, in other words, a software that's tracking the day-to-day activity of the stocks and bonds. Sometimes people get confused with that because that's what they want. They want to look at something that's going to give them investment advice like real time as time passes. That's not what this does. There's many other softwares that can kind of run charts and whatnot like that. What QuickBooks does is basically tells you where you stand at any point in time and helps you to generate basically an income statement so that you can see your performance basically in general over a time frame. When you get into individual stocks and bonds, individual mutual fund performances, then you can look at the actual website that you're investing with or possibly use other softwares that get into more detail on those individual types of items. So that's going to be the general rule. Let's just do the transaction and then we'll talk about it a little bit more. So now what's the form I'm going to use with the transaction? If I hit the plus button, you will recall our rule is that I don't want to use the journal entry unless it's the last resort, even though all the forms basically make a journal entry, but I want to enter it by form because the forms will link together more properly than just doing it with debits and credits, as you might have learned if you learned from a textbook, for example. So then the rule would be, is there a form that is designed for this particular transaction? In our case, we're taking money out of the bank and putting it into investments. That doesn't happen all the time. That's a rare transaction. Therefore, there isn't a form in the normal cycle for the customer cycle, which is the money coming in cycle typically from customers, or the expense cycle or vendor cycle, money going out for purchases, or the payroll cycle. None of those cycles have to do with putting money into an investment because it doesn't happen routinely on a day-to-day, week-by-week, month-by-month basis. I mean, you could have it come up on a month-by-month basis. You might set up some kind of automatic transfer, right? But typically, it's not something that happens on a month-by-month basis. So then the question would be, is the checking account affected? Because if the checking account is affected, which it often is in many transactions, then if it's going down, I can use the expense form or check form. And if it's going up, we can use a deposit form. In this case, it is affected. We're taking money out of the checking account, putting it into the short-term investment. Therefore, I can use this form instead of having to default to the journal entry, which is basically the last resort. Okay, so now as we do this transaction, then if I go to the first tab, note that you might actually facilitate the transaction first. If you were doing this in practice, you might try to facilitate the transaction with your bank, investing from the bank into, say, E-Trade or something like that for short-term investments, and allow the electronic transfer to happen and then go into your bank feeds. And you will then see it come out of the bank feeds and it would go into then the other institution. And by the fact that it would be going into E-Trade or something like that, that's how you would then determine that what it was for. And then you can assign it to the account which would be short-term investments. So we'll talk more about setting up the bank feeds in a future presentation. For us, we're going to enter it in there with the use of the forms. The forms would still be used even with the bank feeds, but we want to take a look at the forms individually. So we said we could use an expense form, which is like the form that you would have for an electronic transfer. It would look like this, where we would have the category down below. Now, if I'm doing a transfer like this, however, I might use the register like we did in a similar fashion with the deposits, because it's a little bit faster to do the data input. So instead of using this form, I'm still going to have an expense form, but I'm going to do it with the use of the register by going to the transactions and then into the chart of accounts. And then I'll close up the ham boogie. And then in the checking account, I'm going to go to the view register on the right-hand side. And then I'll select this little drop down. And this is where I'll choose the expense form here. And then we'll do this as of 010425, let's say. And let's say that we're going to pay it to Vanguard. So again, Vanguard is not really a customer or a vendor. So it's trying to think like, what should I set this up as? And it's putting it in here as basically a vendor. We could put it in there as a vendor or a customer. Maybe I should more properly put it as a customer. It doesn't really matter, because it doesn't fall into the category of really vendor or customer, because it's not someone that's paying us. Although I'm thinking customer because we're hoping we're going to generate revenue from it. And we're not paying them in particular, although we are investing in their, as opposed to buying goods and services. So, but we have to choose one or the other. So I'm going to say, I'll choose that and I'll say save it. And so we're going to say maybe in the memo, invest in short-term assets, let's say, and we're going to make a payment. Let's say it was 12,000. And then the other side, I have to put somewhere. Now I'm going to look into my accounts and see if they have an account for investments. So we have owner investments. That's not what I want. I want an account that's going to be not an equity account, but an other current asset type of account. So what I'm going to do is make another account. I'm going to add the account on the fly, creating the chart of accounts as we go. Remembering the general strategy for the chart of accounts is we're going to keep the chart of accounts given to us by QuickBooks. Look at the chart of accounts whenever I do a transaction to see if they have an account that suits our purposes. If I like it, I'll use it. If I like it, but I think the name should be tweaked, I will adjust the name by editing the account so as not to have two accounts that are similar in name, which might lead me to post to two different accounts when I do my bookkeeping. And then after 1 to 2 months of data input, I will then go into the chart of accounts and make inactive those accounts not being used, making then future data input as easy as possible. Let's make a new one here. I'm going to call it a, what am I going to call it? An other current asset account. And then the detail account here isn't as important because I'm not even sure why exactly you need this account, but I'm going to call it investments other, and I'm going to say investments, and then I'm going to call it short-term investments. Okay, and then I'm not going to make it a subsidiary account. We'll keep it there and then save it and close it. So there we have it. What's this going to do when we record it? It's going to create an expense form, not just this little thing. It's going to make that whole expense form. It's going to decrease the checking account by 12,000. The other side's going to go to short-term investments on the balance sheet. Nothing happening to then the income statement. Let's go ahead and say save it, and then we'll check it out. Let's go to the balance sheet, run it to refresh it. We want to be working with fresh materials here, just like I like my fruits and veggies. They have to be fresh. Otherwise, I'll make banana bread out of it or something, because I'm whatever. So here it is. Hold on. There it is. It didn't load up. I refreshed it, so it came in here. So there it is. So expenses, it's an expense type of form. The name is Vanguard. The split or other account impacted is the investment account that we just set up. It decreased the checking account by 12,000. If I go into it, drill down to the source document, I get to an expense form. It doesn't take me back to the register, but to the expense form that we created by entering into the shorthand register. And there's the investment by category down below. Closing this back out and going back to our report. The other side should be on the balance sheet, short-term investments. There it is. There's the 12,000. Let's go into it. And so it didn't do it again. Let's go back. Let's refresh it and run it. So sometimes it gets a little wonky. I don't know why it does that. It shows up here, but it's not in the data or in the detail. There it is, popping up in the detail. So there we have it. So let's go back up. And nothing happened to the profit and loss still. So let's go to the P&L. We still haven't generated any revenue. We're just playing around with the capital that we put together that we now want to be investing in order to generate revenue in the fixed assets before we start generating revenue with those fixed assets. Let's go back to the tab to the left and a few more just notes on the short-term investment. Now, if you like research investing in investments in like a textbook for a corporation according to, say, generally accepted accounting principles, for example, or international standards or whatever, the general idea of investment can be a little bit confusing. Number one, because investments, the term investment can be used for multiple different things, meaning when we hear investments as an individual, we typically think investing in stocks and bonds. But from a broader perspective, when looking at accounting for a business, you can also consider basically all of the assets as an investment. Even the checking account, even the cash is an investment in the sense that we took the money out of the owners or out of the bank and put it into the business because we expect to use it within the business to buy stuff to help us generate revenue. Otherwise, it would be in our checking account on the personal side, right? And in particular, the inventory is, of course, an investment because now we're holding on to this inventory, which is a liability, especially if you're in California where they just let people rob you just willy-nilly. So it's like if you buy a bunch of goods and you have to go down the road and you got a bunch of criminals out there ready to steal stuff from you, but you're taking them on, man. You're going to sneak it past them, or you're going to try to get to where you need to go so you can actually sell your goods. That's a big investment, right? That's taking on risk. Same with the property, plant, and equipment. If I'm buying machinery and equipment, see, it takes kind of guts to do that, right? Because of course, obviously, the person that doesn't have anything's got nothing to lose. The bandit that just robs people doesn't have anything. But if you're traveling down that road with a truck full of goods, especially if you're in like California where they just let people rob you and let the whole place burn down and then point fingers on who did what, you know, that you're taking on a substantial amount of risk when you start the business, right? You're setting the roots down and you're trying to. And so that could be termed an investment as well. So that's one thing we have to be careful of is just the terminology of what we mean when we're saying it's an investment. Now, if we're investing in stocks and bonds, then we're also going to have we have the problem of how do I want to group the stocks and bonds? So once again, we put them into a short-term investment here. So you could think, shouldn't I put it in? Maybe sometimes I should put it in as a long-term investment because a short-term investment means that I'm going to be using it in a short basis of time. Now, from a textbook problem, you've got, the generally accepted accounting principles tries to give a pretty defined definition of when it should be short-term versus long-term and so on. If you're going to hold it to maturity, then you might have a long-term investment and whatnot. I don't want to get into that in detail, but the general idea is usually you would think it would be kind of a short-term investment unless you're in the business of holding on to stocks and bonds because you're going to use it at some point, cashing it in to generate the cash in order to buy the equipment, which is the reason you're holding it on to it basically in the first place. But if it was bonds or something that you expect to hold to maturity, and maturity is a fairly long amount of time, over a year at least, then you'd think you might put it into basically a long-term investment. You also have the question of how do I group the investments? What I would typically say is by institution. So E-Trade, Vanguard, whatever form of investment that you have, I would put it in there by institution would be the general idea, so that you can then make your adjustments as easy as possible. So I might make a parent account if I had multiple investments called short-term investments. I'm on this one, short-term investments. And then under that, I might then put the people that I'm investing with, or the companies, E-Trade, Vanguard, Bank of America, or whatever, and then group the investments in those by the institutions I'm investing with. Now, if you had personal investments on your personal bookkeeping, you might have some investments. It's more likely that you will have long-term investments in that case. And so you might use QuickBooks to track that information. In that case, you might have long-term investments, and the most easy way to define if it's a long-term investment to me would be, is it under a retirement plan, like a 401k plan, an IRA, or a 403b plan, in which case you can't get to it. So if you can't get to the money because it's under those plans, I would then put it in a long-term asset as opposed to a short-term asset, so that you can then differentiate the money that you have that you can actually access in some relatively quick amount of time in the event of an emergency, versus the long-term assets, which you can't really get to without being penalized unless some specific circumstance comes up, or until you retire, right? That would be the general idea there. Now, going forward, what's going to happen with these investments? We invested in stocks and bonds to generate revenue in the form of interest if it was bonds, and capital gains as well as dividends if it were stocks. So the question going forward is, well, how am I going to deal with that when I generate interest and dividends and the capital gains? How do I deal with that? Well, if you have the interest and dividends, if they were paid out to you as they accumulate, meaning dividends are the earnings that are distributed to the owners, similar to draws, but for a corporation in investments, and interest is the earnings that you have for loaning the money, for renting the money on a bond, for example. If you just have that money go from the institution into your bank account, then you're going to see them, if you have bank feeds on, as the bank feeds come through, and you could just record those deposits or those increases as revenue on the income statement. So we'll talk more about that possibly in future presentations. I'd put it on the income statement. I wouldn't put it under general income, though. I would put it on the bottom of the income statement as other income, because it's not part of my normal income. So I'd put it under other income on the bottom of the income statement. And then let's go back on over. What about stocks? If they're stocks, the stocks hopefully will go up in value, but could go down in value. That's the other way we get value within them, because then if I sell them, I'm going to have a capital gain or capital loss. So for that, I would do a periodic adjustment, right? So how would we do a periodic adjustment? We get the statements that are given to us either on a monthly basis, quarterly basis, or possibly even just a yearly basis. And then we adjust our number that we have in the books to what the current value is on the stocks. Now, you might ask yourself, this question comes up from a bookkeeping standpoint, from an accounting standpoint, why is it that sometimes we adjust our assets to the current market value and sometimes we do not? Some types of accounting standards do that more often and some don't. This is a constant argument in accounting regulations. Should you be revaluing things to the fair market value or keep them at an adjusted book value? So the classic example is for fixed assets, for example, where in the United States, especially for like buildings and equipment, the argument typically still seems to be we want to keep it at a cost allocation method rather than a fair market value method. And for everything but buildings, that seems like to work fairly well, because if you have a forklift, for example, you don't expect the forklift to go up in value. You expect it to go down in value. It's just a question of how are you going to allocate the decrease. It's an estimate so that you can allocate the cost over the useful life of the forklift. Otherwise, what would you have to do? You'd have to take all of the equipment, if you're a construction company, and try to reevaluate the cost of that equipment every year based on some kind of appraisal to record it at the book value. That's difficult to do. But on a building for long-term assets, a little more complicated, because if I have an office building that I bought, or you have or a house on the personal side, then it's quite likely that it goes up in value, even though it's a long-term assets, not because of the wear and tear on the house going down necessarily, but because of just simply the location might allow it to go up in value. So then you end up with these situations that if you put it on the books at depreciated cost, it might be wildly different than what the current fair market value is, and therefore people argue that you should be putting it on the books for the fair market value, which is going to be a lot higher. So obviously the problem still with the building, however, is that we don't really know how much the fair market value is until you actually sell it on the market, because there's all property, plants and equipment, and especially real estate, is unique. There's no other piece of real estate that is exactly like the one you're looking at. So everything is an estimate. And anytime you put in these large estimates into play and you hire somebody based on the estimate, and they know perfectly well whether you would rather have a high or low estimate on this thing, you enter an ability for people to distort the books, right? By having estimates, and now we're relying on these estimates, and then there's a question on the reliability of the people doing the estimates, and so on and so forth. So it becomes kind of a mess. That's kind of the argument there. With regards to the stocks, if they're publicly traded stocks, then there's a better argument to then adjust the books to the fair market value. Why? Because the stocks are all the same. They're publicly traded. We can see what they're trading for at any given day because they're all the same, and we can see what they're trading for. So it makes sense then to mark our stocks to the fair market value a little bit more than the property, plant, and equipment. Although if we were a large company, then if we were to sell our stocks, it would probably distort the value of the stocks because we own so many of them, right? So it's still not a perfect kind of situation. Or if it's not a publicly traded company, then we don't know what the stocks cost again, because the company is unique and none of the stocks are selling on a public exchange. So in any case, usually we're putting money into a public exchange. So usually, whether we're on the personal side or the business side, we can adjust our investment to the fair market value by looking at the monthly statements or quarterly or yearly statements that we're provided with. And then we have the option of either adjusting this number directly, the number per institution, Vanguard, E-Trade, the Bank of America, or I can make a sub account, which is going to represent the increase or decrease, so that I can still have the cost on the books, and then the sub account being the increase or decrease to help me determine the capital gain and losses. And then the next question is, the next question that comes up is, well, what if this went up by $500? If I increase it by 500, where does the other side go? Because I didn't actually sell it. You would think it would go on the income statement, which is where most people would put it. That's the thing that makes most sense. Therefore, you would increase this amount, put the other side to the income statement. But again, not into normal income usually. I would put it on the bottom of the income statement as unrealized income. Unrealized meaning you haven't actually sold the stock, and therefore it's just kind of like an estimate based on what the stock market value is at this point in time. The other option, and again, if you're looking at like accounting bookkeeping standards for like generally accepted accounting standards and so on, there'd be rules in terms of when you would do that versus when you would make an equity account, meaning put it off income statement. So I'm still going to recognize it on the assets, but I'm just going to dump the other side directly into equity so it doesn't go on the income statement. That would be the other option you could do, which again, for small bookkeeping purposes, possibly not the way you would maybe normally do it. The easy thing to do is put it on the income statement. Otherwise, you got kind of a messy equity section over here. So that's going to be the general ideas. So, but that's going to be the investments on that one. Before I wrap this up, I'm going to start to open the trial balance to get an idea of the trial balance, because I think that's the best way to check our numbers as we go. So I'm going to go to the first tab, open up the Ham Boogie, and then go down to the reports. And then I'm just going to type in the report's trial balance. Trial balance, that's the one. And then I'll change the range 010125 to 123125, tab, run it to refresh it. So you can see this is basically just the balance sheet on top of the income statement. There is no income statement yet because we don't have any income statement accounts that we've used yet. But you can see how much easier it is to check your numbers with this trial balance, which is why I recommend it oftentimes as what you can use when you're doing data input instead of having both the balance sheet and income statement open, because you can drill down on these numbers in a similar way to check your data input as you go. Even though there's a debit and credit component, it's not too hard to see where things lie because it's just in order of assets, which go down to here. And then you've got liabilities, which goes down to here. And then the equity section, which goes down to here. After owner's equity would be the income statement if we had anything in it. So you can check your numbers and see if your numbers tie out to our numbers. If they do not, then it's possibly a date range thing. If you're working this problem at a later date, try extending the date range, because when we do data input in QuickBooks Online, it'll default to the current day. Then you can drill down on that data, go back to the source document, change the date to our date so that you're in alignment with us, and that should fix it. If that doesn't fix it, then we will try to review our numbers in more detail with a transaction detail report at the end of each of the main long sections at the end of the month of data input, and we can possibly find the issue at that time.